It is the apex of 2023. A massive global conglomerate is trading at an astronomical price-to-earnings ratio of over 800. The chairman is briefly minted as the third richest individual on the entire planet. Western investment banks are fiercely competing to lend this empire billions of dollars. But look directly beneath this veneer of unstoppable capital accumulation. The fundamental reality is violently inverted. 7 of the conglomerate's key publicly listed subsidiaries are generating structurally negative free cash flow. The enterprise is operating with virtually zero genuine third-party equity demand. The record paper profits and skyrocketing market capitalization are entirely illusionary. They are propped up by a massive labyrinth of offshore shell companies primarily based in Mauritius and the Caribbean. This is the central paradox. The company is raising billions in real fiat debt from Western prime brokers using its own artificially inflated, secretly controlled stock as collateral. It is a public market entity that has effectively privatized its own float. If you want to understand how public markets lie, you have to look at the plumbing. Hit subscribe to join the few who understand the system. Now, let us go to the incubator where the ghost float was born. August 14, 2001, Port Louis, Mauritius. The heavy, humid air of the Indian Ocean clings to a crumbling colonial-style facade. Inside the offices of a notorious corporate services provider, the environment is aggressively sterile. A single bored clerk stamps incorporation documents under a flickering fluorescent light. There is no trading floor here. There are no computer servers. There is no actual business being conducted. There is just a massive wall of brass nameplates. A shredder hums quietly in the back room as a new entity is birthed on paper. A single post office box is assigned to hold the equity of what will eventually become a multi-billion-dollar infrastructure empire. The air conditioning rattles loudly, masking the sound of fax machines receiving forged import invoices from Dubai. This sterile room is the incubator. This is exactly where a company decides it will not play by the traditional rules of free market capitalism. Instead, they choose to rewrite the laws of supply and demand entirely. They are creating the ultimate financial weapon, designed to bypass the scrutiny of the domestic regulatory state. They are building a synthetic ghost float. A corporate fixer sits across from a promoter's legal representative in a heavy leather chair that smells of old cigar smoke. The fixer slides a plain manila folder across the mahogany desk. He taps a thick stack of foreign registration forms. Ensure the beneficial ownership remains fully masked behind the nominee directors, the fixer says, leaning in close so his voice barely carries over the humming fan. The local domestic regulator must only ever see the fund manager. They must never see the underlying capital source. The representative nods slowly, tracing the corporate organizational chart with a silver pen. And the capital? He asks quietly. It flows through the British Virgin Islands first, the fixer replies without hesitation. By the time the money hits this desk in Mauritius, the legal chain of ownership is completely broken. You control the fund, but your name is nowhere on the paperwork. They shake hands. In that brief exchange, a ghost is born. An entity that looks completely foreign and independent, but is completely controlled by the corporate founders. The mechanical execution here completely subverts the strict legal requirement of a minimum public shareholding. To legally trade on a public exchange, a company must maintain a 25% public float. This means 25% of the stock must be owned by independent investors, which mathematically prevents the founders from cornering the market and arbitrarily dictating the price. But the ghost float shatters this rule. The founders use their freshly minted offshore shell company to buy that exact 25% float. On paper, the shares are owned by a foreign portfolio investor based in Mauritius. The domestic regulator looks at the corporate spreadsheet and sees a compliant, publicly traded company with strong foreign institutional backing. But in reality, the promoters already own the legal maximum of 75%, and they secretly control the remaining 25% through their offshore proxies. They have effectively cornered 100% of their own market. The public exchange is nothing more than a carefully orchestrated theatre. But the system requires one necessary input to function: cold, hard cash. Setting up an opaque offshore shell is only the first piece of the puzzle. An empty corporate entity in Mauritius is utterly useless if it does not have hundreds of millions of dollars in cold, hard cash to actually buy the stock. The promoters need massive capital to fund their own ghost float, but they cannot simply wire the money from their personal domestic bank accounts. That action would instantly trigger money laundering alarms and expose the entire operation to the authorities. They need to extract legitimate cash out of their domestic public company, wash it across multiple international borders, and sneak it into the Mauritius fund without anyone noticing. To execute this extraction, they do not turn to Wall Street bankers or European hedge funds. They turn to the dusty, sprawling industrial shipping ports of Dubai, where the line between legitimate global trade and financial fiction completely disappears entirely. They are about to transform heavy machinery imports into a massive wealth extraction mechanism. The real theft from the public shareholders is about to begin. October 9, 2010. A sweltering shipping terminal in Dubai, United Arab Emirates. The harsh smell of diesel fumes and salt water hangs heavy in the humid air. Massive steel cranes slowly load shipping containers onto freighters bound for South Asia. But the real commodity being traded in this port is not heavy infrastructure machinery or raw coal. It is forged paper. In an unmarked, air-conditioned office overlooking the docks, a clerk is generating invoices for a shadow vendor. This vendor is legally registered in the United Arab Emirates, placing it completely outside the legal jurisdiction of domestic financial regulators in India. The vendor is officially listed as an independent third-party supplier for the public infrastructure conglomerate. But the vendor is quietly controlled by the promoter's own brother. The clerk types out an invoice for heavy power plant equipment, but the price tag is deliberately staggering. It is marked up by 50% over the actual global market value. The printer churns out the fraudulent document. The capital extraction phase is now violently active. Back at the corporate headquarters of the public company, the chief financial officer presents the purchase order to an internal auditor. The auditor squints at the Dubai invoice under the harsh boardroom lighting. "We are paying $150 million for this machinery," the auditor says, pointing sharply at the bottom line. The actual global manufacturer lists this exact equipment for $50 million. Why are we using this unknown intermediary in Dubai? The chief financial officer does not blink. "Supply chain logistics and specialized procurement services," he replies smoothly. "The vendor guarantees delivery and assumes all the transit risk. Approve the transfer." The auditor knows something is structurally wrong, but the paperwork is technically flawless. The vendor is a legally separate corporate entity. The auditor signs the authorization. $150 million is wired out of the public company's accounts. $50 million goes to the actual manufacturer. The remaining $100 million of pure profit sits in an unregulated bank account in Dubai, completely stolen. This mechanism is capital extraction through fictitious invoicing. The public company is legitimately building infrastructure, but it uses shadow vendors to siphon cash out of the enterprise. Think of it as a reverse robbery. Instead of physically breaking into the vault, the bank manager writes a perfectly legal check to an external contractor for a job that costs a fraction of the price. The shadow vendor pockets the massive, unjustified markup. But that $100 million in stolen cash cannot go straight to Mauritius. It must be carefully layered. The stolen cash in Dubai is chopped into 5 distinct tranches of $20 million. Those tranches are wired through multiple opaque jurisdictions, often passing through the British Virgin Islands or Cyprus. This intentional complexity completely severs the chain of beneficial ownership. By the time those funds aggregate back together into the foreign portfolio investor account in Mauritius, the money is completely clean. The stolen cash is now fully ready to be weaponized on the open market. The Mauritius fund now holds $100 million in freshly laundered cash. The offshore fund manager immediately logs onto the trading terminal and starts buying the stock of the original public company. The architectural loop is now complete. The promoters have systematically stolen cash from their own company, washed it offshore, and used it to buy their own stock on the open market. But there is a terrifying side effect to this strategy. Because the offshore shells are soaking up all the available public shares, the actual tradable supply of the stock drops effectively to zero. The float is completely squeezed. Any tiny movement in buying pressure will send the stock price violently upward. The promoters realize they do not just have a way to hide their ownership. They have discovered a structural machine that can artificially inflate their market capitalization to infinity. The operation mutates from a simple tax evasion scheme into a systemic market manipulation engine. And Wall Street is about to reward them for it. September 16, 2022. A private aviation hangar at the international airport in Mumbai. The heavy smell of aviation fuel mixes with the scent of expensive leather. Outside, intense heat waves severely distort the tarmac. Inside the air-conditioned cabin of a Bombardier Global 6000, high-level executives and compliant European bankers are comfortably clinking crystal glasses. iPad screens mounted to the bulkheads display glowing green financial tickers. The conglomerate stock has surged another 5% this morning. But look closely at the underlying trading volume. It is less than 200,000 shares. The total lack of liquidity is the primary weapon. Documents for a massive new $2 billion margin loan facility are signed on a polished mahogany fold-out table. The executives smile warmly at the European bankers. The collateral backing this massive loan of real fiat currency? It is the exact same stock the offshore Mauritius funds artificially pumped up just hours earlier. The illusion is finally being monetized into hard, tangible currency, securing their untouchable status. 3,000 miles away, in a sprawling London banking tower, a senior risk officer is staring intensely at the collateral reports. He picks up the phone and calls his managing director. "We are extending billions in real cash against paper collateral that they are clearly wash trading among themselves," the risk officer warns, his voice tight with anxiety. "Look at the volume. If the music stops, we own $2 billion of completely illiquid air. We need to cap the margin facility immediately." The managing director heavily sighs, looking at the massive spreadsheet of advisory fees the bank is scheduled to earn. "The stock is up 400% this year," the director replies coldly over the phone. "They have deep domestic sovereign backing. If we do not write this margin loan, Credit Suisse will absolutely write it tomorrow. Approve the facility." The systemic warning is completely ignored. The upfront advisory fees are simply too high to walk away. The bank willingly accepts the toxic collateral. This precise mechanism is margin monetization. The company's market capitalization is artificially inflated by 1,000%. But the promoters cannot actually sell the stock to realize the cash, because dumping millions of shares would instantly crash the price. Instead, they use the inflated stock as collateral to take out massive margin loans from legitimate Western banks. Consider the Hall of Mirrors mortgage analogy. Imagine you desperately want a $10 million loan, but your house is only worth $1 million. You put on a fake disguise, use your own savings, and buy your house from yourself for $2 million. You change disguises and buy it again for $5 million. You do this 10 times until the official public record shows your house just sold for $10 million. You walk into a real bank, show them the official sales record, and they happily give you a $10 million mortgage based entirely on the fake value you created using your own disguised money. The promoters have successfully converted synthetic offshore equity into real, spendable fiat currency. They are drowning in extreme leverage, but they retain absolute dictatorial control of their empire. Yet there is a fatal structural flaw in the margin debt machine. Once the loan is legally finalized, the stock price becomes a matter of absolute life and death. If the share price drops below a specific negotiated threshold, the prime broker will issue an automatic margin call, demanding billions in immediate cash. If the promoters cannot pay, the bank will forcefully liquidate the stock, triggering a catastrophic market collapse. The offshore shells must constantly wash trade shares back and forth to keep the price artificially elevated above the margin threshold. The fraudsters are now permanently trapped on a terrifying treadmill of synthetic liquidity. And worst of all, the massive artificial spike in their market capitalization has just triggered the blind, robotic buying algorithms of Wall Street. They have accidentally summoned forces they can no longer control, setting the stage for a global financial collision. November 4, 2022. A high-frequency trading desk in Midtown Manhattan. The expansive trading floor is totally silent, except for the low hum of server cooling fans and the frantic clicking of a mouse. A quantitative analyst is staring at a glowing Bloomberg terminal, his eyes bloodshot from staring at order book data for 12 hours straight. He isolates the trading patterns of the Indian infrastructure giant. The buy orders are perfectly rhythmic, almost robotic in their execution. Small blocks of shares are being traded back and forth between 3 specific Mauritius funds at progressively higher prices. There is absolutely no natural price discovery happening here. It is a synthetic, algorithmic heartbeat keeping a dead patient artificially alive. The analyst pulls up the corporate ownership register. The foreign portfolio investors hold exact, static percentages of the float for years without selling a single share. The quantitative models are screaming that the float is entirely fake. The foundation is loudly cracking, but passive institutional money is pouring in faster than ever. A senior portfolio manager at a major passive index fund is reviewing the daily rebalancing sheets. He aggressively calls over a junior analyst. "The emerging markets index just updated," the manager says, pointing aggressively at the screen. "This infrastructure conglomerate just breached the massive market cap threshold. The algorithm says we need to allocate $500 million into their stock by the closing bell." The analyst looks deeply uncomfortable. "Sir, the available float is practically non-existent. We are buying at an 800 times earnings multiple. The independent sell-side research says the valuation is pure fiction." The portfolio manager shakes his head, resting his heavy hand on the desk. "We are an index fund. We do not do deep due diligence. We do not have an opinion on the valuation. The algorithm dictates the purchase based entirely on market cap size. Execute the trade immediately." Hundreds of millions of dollars of teacher retirement money blindly flow directly into the offshore trap. This is the structural trap of passive index inclusion. Passive investing is undeniably the greatest blind spot in modern global finance. When offshore shells use illegal wash trading to push a stock into the stratosphere, the total market capitalization artificially balloons. Major global indices automatically include companies based purely on this market cap size. Once included, asset management giants like Vanguard and BlackRock are algorithmically forced to buy millions of shares. The passive index funds act as massive, unwitting exit liquidity for the fraudsters. Think of the helium anchor analogy. Normally, thousands of different public investors act as individual heavy anchors, keeping a stock firmly grounded in reality. The promoters secretly sever all the public anchors and replace them with massive, hidden helium balloons. To the outside world, it looks like a massive steel ship is magically floating above the water, defying gravity. But there are absolutely no real anchors holding it steady. It is entirely suspended by pressurized gas. and it is completely vulnerable to a single, well-placed needle. The offshore architects have underestimated the forensic capabilities of their enemies. January 24, 2023, 6 in the morning, Eastern Standard Time. The highly secured offices of Hindenburg Research in New York City. The sharp, cold glow of multiple monitors illuminates a cramped, hyper-organized room, completely strewn with empty coffee cups and thousands of pages of printed offshore customs records. The atmosphere is completely silent and incredibly tense. Financial analysts are bleary-eyed after a grueling 24-month forensic investigation spanning 4 distinct continents. A single thumb hovers nervously over the Enter key. The exact moment the massive 106-page dossier is published to the live server, an immediate, deafening sequence of digital alerts erupts across the terminals. High-frequency trading algorithms scan the incoming internet data and instantly pick up the heavily weighted keyword, fraud. The server racks light up in a wild frenzy of automated algorithmic sell orders. The report is fully live, and the global financial system is violently waking up to the harsh reality of the offshore plumbing. The absolute destruction of a $100 billion empire has officially begun. The opening line of the published investigative dossier drops like a heavy anvil onto the institutional trading desks in Mumbai. We reveal the findings of our 2-year investigation, presenting evidence that the 17 trillion rupee conglomerate has engaged in a brazen stock manipulation and accounting fraud scheme over the course of decades. Telephones begin ringing simultaneously across 3 different continents. A frantic domestic fund manager sends a terrified encrypted message to a senior state banking official. There is no flaw, the manager types, his hands visibly shaking over the keyboard. The Mauritius funds are not stepping in to buy. If the state insurance corporation does not immediately intervene to absorb the float, the entire margin book collapses by noon. Call the regulator right now. Freeze the tape. But the domestic regulator cannot legally stop the foreign prime brokers in London from protecting their own balance sheets. The catastrophic margin calls are already being triggered across the network. The synthetic liquidity that artificially propped up the entire empire vanishes in an absolute instant, leaving nothing but sheer panic. This terrifying event is a margin call bloodbath. When the short seller report violently pops the offshore helium balloons, the actual liquidity of the stock is immediately exposed as a complete illusion. The stock price plummets vertically because there is absolutely zero genuine buying demand. Bids completely vanish from the electronic order book. Remember the $12 billion in artificially inflated stock the promoters proudly pledged to Western investment banks? The banking executives watch in absolute horror as the stock price slices straight through their critical margin thresholds. The automated risk management systems at Citigroup and Credit Suisse ruthlessly execute automatic margin calls. The banks demand immediate cash deposits to cover the rapidly plummeting value of the collateral. If the promoters cannot wire the cash within hours, the banks will seize the underlying shares and forcefully dump them onto the open market. This action would mathematically drive the price to zero and liquidate the entire infrastructure empire. The artificial loop that took 2 decades to quietly build violently unwinds in real time, consuming billions of dollars. In exactly 5 brutal weeks, a catastrophic $153 billion is entirely vaporized from the conglomerate's market capitalization. The corporate promoters desperately scramble in the dark, liquidating other legitimate assets to prepay over $1 billion in massive margin loans to avoid total corporate annihilation. They barely survive the immediate contagion window by the skin of their teeth, but the financial damage is absolute. Retail and institutional investors who unknowingly bought the inflated equity suffer systemic losses exceeding $80 billion. By all traditional market logic, this should be the definitive end. The complex fraud is completely exposed, the massive financial damage is undeniable, and the intricate paper trail of offshore shell entities is fully documented for the entire world to see. The architects of similar historical precedents like Wirecard went straight to federal prison. But this is not Europe or the United States. The aftermath of a ghost float collapse is dictated entirely by the political jurisdiction of the perpetrators. And in this specific jurisdiction, the regulatory system is about to forcefully close ranks to protect its own financial survival. March 2, 2023. A highly secure, closed-door boardroom at the Securities Regulatory Headquarters in Mumbai. The massive room is heavy with dark, cynical pragmatism. High-backed leather chairs heavily surround a sprawling teak table covered in highly classified, heavily redacted, foreign portfolio investment reports. Heavy monsoon rain lashes aggressively against the thick, soundproof glass windows. Senior government officials sit in suffocating silence, actively avoiding any eye contact with one another. They absolutely know the offshore structures are entirely illegal. The verified documentation is sitting right in front of them on the table. But formally acknowledging the systemic fraud would directly mean admitting that the massive domestic state banks, which hold enormous credit exposures to this very conglomerate, are functionally sitting on toxic waste. Acknowledging the fraud would mathematically collapse the domestic financial bedrock. So, documents detailing the exact flow of funds from the United Arab Emirates shell companies to the Mauritius funds are quietly slid into manila folders officially marked inconclusive. The truth is sacrificed to artificially preserve the stability of the broader financial ecosystem. A relentless investigative journalist confronts a senior regulatory spokesperson in a dimly lit, marble hallway outside the official press room. "You have the forged customs invoices," the journalist says aggressively, holding up a heavily highlighted printed spreadsheet. "You have the specific names of the nominee directors located in Port Louis. Why is there absolutely no formal criminal prosecution for synthetic float manipulation?" The spokesperson sharply straightens his silk tie, his facial expression remaining totally blank. He robotically recites the sterilized, heavily lawyered public statement. The official regulator has drawn a blank in its extensive efforts to uncover the ultimate beneficiaries of the offshore funds, he says smoothly. "We are citing severe jurisdictional limitations and incredibly complex, multi-layered financial structures. The foreign entities are strictly protected by local privacy laws." He immediately turns and walks briskly back into the secure boardroom. It is a massive, systemic blind eye, formalized in permanent ink. The political cost of exposing the brutal truth is simply too high for the sovereign state to bear. The cover-up becomes official policy. This entire regulatory cover-up relies heavily on the legal mechanics of jurisdictional arbitrage. Domestic financial regulators only have legal subpoena power within their own sovereign borders. By intentionally parking the beneficial ownership of the shell companies in places like Mauritius or the British Virgin Islands, the offshore architects brilliantly exploit the massive friction of international law. The domestic regulator can heavily point to a suspicious Mauritius fund, but the sovereign Mauritius government will simply cite strict local banking privacy laws and aggressively refuse to hand over the true names of the ultimate beneficiaries. This calculated legal roadblock gives the domestic regulator a highly convenient, politically safe excuse to permanently close the investigation. They can throw their hands up and publicly blame foreign sovereignty. It is the absolutely perfect legal firewall. The state banks do not have to mark down their highly toxic loans. The index funds do not have to admit they bought fake equity, and the corporate promoters remain completely untouchable, retaining absolute control over an empire built entirely on a foundation of regulatory shadows. But do not think for a single second that this financial architecture is merely a historical artifact. The ghost float loophole is violently active across global public markets today. Right now, heavily hyped mega-cap stocks with surprisingly low daily trading volumes and highly concentrated founder ownership structures are sitting silently in your retirement accounts. The massive global integration of environmental and social governance mandates has dramatically accelerated this systemic danger. Obscure offshore shell money is routinely rotated into green energy subsidiaries specifically to attract blind Western institutional capital, effectively allowing heavy infrastructure barons to finance their operations with synthetically obtained valuations. The next massive offshore float is inflating as we speak, hiding comfortably behind brass plates and algorithmic index buying. If you rely solely on the official state regulators or passive indices to protect your capital, you are functionally acting as the blind exit liquidity for the architects of the ghost float. Hit subscribe to stay sharp and never inherently trust a valuation you cannot independently verify. The system will not protect you. You must actively understand the invisible architecture of capital before it collapses completely.